that should have a national ID system should be able to provide a baseline from which a pension system could actually be built upon. I think there are great examples. For example, in Mexico, there's significant innovation in terms of making contributions to individuals. They have a national ID, a national ID number. In Kenya, I'm sure we'll hear more, and I'm not going to steal anybody's thunder, but they have M-Pesa, which is working quite adequately in terms of making contributions flow into a system. I think that is one of the big part of it. The other big and important component is to be able to dialogue between the different pension systems itself. So for example, if you have a formal sector pension system, to be able to incorporate or to be able to understand what type of benefits any particular individual has in order to be able to better target government subsidies or be able to provide better benefits to a given individual will provide a baseline. But we cannot do that without a core national ID system in the background. I think that naturally, I think government has a big significant role. I think the pension administrators themselves have a significant role in order to not only be accurate in identifying in terms of KYC, but also to be able to properly disclose, as you were saying, the actual information that is relevant to the individual. So those are, I think, some of the key components that I think are worth mentioning.
Thank you. If I could move to Shem, I'm interested. He mentioned Ernesto mentioned M-Pesa. How is the fact that you are leaders in mobile technology, mobile banking in Kenya, mobile payments transfer, affecting this space, and then other comments that you might want to make from your perspective in the Retirement Benefits Authority?
Okay. Thank you very much, Margaret. I think for us, I'll speak from the point of a regulator. And we found ourselves in a situation which was challenging, as has been observed here. Globally, 1.2 billion excluded from pensions as a financial service. Our challenge comes from the structure of our labor market, which is skewed, like in many developing countries, towards the informal sector. And we have most of our workers there, literally about 85% of them. And most of those are not covered in any pension arrangement. And so that got us thinking. And it got us thinking because many of them, I could even say 90% of them, don't have any formal pension arrangement. And that would really speak to what the first speaker of the day said, would lead directly to very severe old age pension, old age security. And the reason why you had that challenge is that because the existing pension arrangements really were not very accommodative for this class of workers. We have a pension system that is largely voluntary, so we have very many occupational pension arrangements. And if you understand occupational pension arrangements well, they are more or less run like labs. It means if you're not working for that employer, you cannot get included into it. We have a few independent pension plans that can be able to play that role, but again, the way they are structured as well means that they cannot really accommodate informal sector workers who have very peculiar attributes which needed to be accommodated. And I just want to mention two of these. One of the attributes they have is that informal sector workers generally earn low incomes that are also irregular because they are either seasonally engaged in the way of finding jobs, and so when they do not have jobs, they cannot make contributions. And that says that then, because existing pension arrangements demand a certain predetermined amount of contributions on a regular basis, mostly on a monthly basis, then they would not fit. And so we had a challenge. So how do we include this particular group in pension arrangements? And we are thankful because of the history of M-Pesa, really. We've learned a lot from that. Moving from a population from another population of about 26.7% included in the provision of basic financial services in the year 2006 to about 75% today as we speak, and that figure could already have gone up. We shall be able to determine that in the next year or so. That speaks volumes for us, and so we thought there's really something to learn. And we borrowed something from, and that was largely in the banking sector, and said, well, we have been able to achieve this, but other services in the financial sector have lagged behind, and one of them is pensions. Because we have a pensions coverage of just about 19% of the total workforce, and so we said the way to go is we needed innovation. And I think the fintech companies have really come in and played a very important role in terms of being able to allow and design a pension arrangement. We just have one, and we think we can multiply it going forward, that is able to attract savings from informal sector workers, irregular as they are, small as they are, and attract them into some form of pension arrangement. And that establishment today as we speak is one of the largest independent pension plans we have. And we think we can only do better than that. So we are seeing, although not to steps that we would have expected, but we have seen some significant lessons from that. And for us is then to be able to do this going forward. So what has worked for us, the M-Pesa effect, we have a national ID system and a young population that is, we could say, are really digital. So they are really in the driver's seat as far as doing digital financial services is concerned. And I want to attribute some of these achievements to the regulator. We have 5 domestic sector regulators, 1 for pensions, where I work, 1 for banking, the Central Bank of Kenya, 1 for insurance, IRA, Insurance Regulatory Authority of Kenya, and 1 for SACCOs, SACCO Societies Regulatory Authority. And the lesson we learned from the way M-Pesa was initiated and done and the drive it has been able to achieve in growing the financial inclusion space is the regulator decided to be also innovative in the way it was regulating. And simply because the regulator did not understand the fintech development, the fintech revolution that is developing very fast, he said, let us wait and see what happens. Let the innovators come, let them do their products, let them market them, let people enroll, and let's see what happens thereafter. So they have been following, as is expected of regulators who are laggards, following the developments with regulations. And I think this is a very great lesson for us in the retirement benefits sector, and we think this is the way to go in terms of growing pension coverage to actually be able to bring on board informal sector workers. And I think we are reading great lessons from there. Thank you.
Thank you, Shem. You did a very good job representing the regulator, and I think this is a key point, and it was something that was raised in a meeting I was at yesterday on a fintech policy roundtable where Samnundu was as well, the importance of that innovation mindset for the regulatory community, and that it's because you tend to get maybe criticized more for the problems that come up than when things go well. I think it's important to recognize that part of the ecosystem and the partnership that has to exist. So thank you for highlighting that. Eric, if we could come to you next. You have a broader ambit, but obviously within that pension funds, but I'm just wondering how you see this also in that broader space, for example, alongside promoting savings in general, and then retirement savings specifically, but looking forward to your comments from the perspective of the Ministry of Finance and Policy in Rwanda.
Thank you so much, Margaret. Right. I think for me, I will speak more from the side of the policy and policymakers. My portfolio, I oversee the whole financial sector development from policy perspective, and definitely work closely with the regulator. The kind of situation that Shem touched on the background in Kenya, which is just close to Rwanda, is the same. And so for us, when we looked at that situation where he said 90% of our workforce was totally excluded, is still excluded, I think the few points I'm going to talk about are more from a policy perspective. I think the first key critical aspect of it is getting the government commitment to be able to understand the situation that Shem described about the exclusion, is very important to set the discussion where everyone is involved and is on the same page. It be from the private sector, it be from the regulator, it be from the policymakers, but also from the development partners. And so for us, that's where the discussion started. Get everyone on the table and try to understand the issue at hand. I remember when we looked at that and we teamed up a team. We got a team about 5 people from the regulator, from policymakers, from the financial sector players, and we discussed it and went to India actually on a study tour to see how do you get these things. The first thing to understand is the problem in the room, a real problem, and we have really probably been able to leverage on that in a great way to move forward. The other aspect I want to touch on is how do you take stock of the progress made in the wider financial inclusion? And so when we looked around, we realized Rwanda is a country with about 11 million people, and we have, probably they have even increased, about 7.9 subscribers on the 3 telecom operators. And these are very active members, and they're using all sorts of innovation solutions, mobile payments, mobile transfers. The third aspect is the national ID. Everyone in Rwanda has a national ID that is linked to all payment systems, linked to all national data, linked to all to whatever. If I have my ID, for me, if I'm to choose between taking my ID and my passport, you take my passport, because I can't do anything without it. So for us, that is something that we still think that is very critical as we think about this. Now, tying all these 3 things, and probably there's more that we can consider, but for us, when we looked at the government and all the stakeholders' commitment and to address this problem, get all the data linked to the national ID, where everyone has a national ID, and then we asked, and then the third component, the financial inclusion ecosystem. So until last year, we had about 89% of the people financially included, both formal and informal. In fact, we have moved to a point of those who are familiar with the community serving groups. So probably excited about the trends in technology. They are now being automated. So instead of the boxes, those are familiar with that practice, now they are being replaced with some sort of technology. And we think all these developments in ecosystem financial inclusion is what we want to leverage on to offer to these people who are financially excluded some sort of pension. And as I will speak, we are at the level of implementation, thanks to Pinbox team that we worked together all the way from the development to the point where we're implementing. But I think what we believe in, all the 3 components, and also including the aspect of technology or fintech is going to be very critical. I just want to mention one thing that we have tried also to see how do we bring in insurance and wrap it together with the pension, because the same people, kind of low income, very irregular, but these issues, they're so dear to them. So how do you get that? So we want to put both schemes, the insurance and the pension, in a way together. We can discuss that later during coffees. But we think this is feasible. And Margaret, that's the few components I wanted to touch on from a policy perspective. And lastly, the government has agreed, the government of Rwanda has agreed to provide some interesting incentive package in terms of matching contribution, in terms of some fiscal in nature. But all these things probably, I'm a bit shy to talk about them because we haven't launched it at national level. But I think the intentions are very exciting. Thank you so much.
Thank you very much. Several points we'll look forward to coming back on: insurance, cybersecurity, the ID. Dubel, if you could finish the first comments of the panel, and I'm very interested. You mentioned, how far can fintech go when we were just chatting over coffee. So, maybe, are you going to be a little bit of a dose of pulling us back to the ground from what
call
may
me
be
a skeptic.
possible?
No, I'm extremely optimistic about what we can do, but I'm also very exposed to the realities of the markets what we are trying to solve. And so it's great being part of this conversation. I think it's the right conversation to have about dealing with old age vulnerability. I guess some of the questions to ask is about what are the best tools to deal with old age vulnerability, and whether pensions is the only or the best for all of these segments that we are talking about. When I look at this topic, I very much think about pensions for the new economy, not micropensions for emerging markets. And what we call the new economy, one that's decentralized, disaggregated with less central structure and less central employment by large employers. This may be called the new economy here in the US or the first world, but it's the only economy really in the emerging markets. So when I look at fintech and the discussions here over the last days at the IMF and the World Bank, there's a lot of concern about how this is going to informalize and disaggregate this very structured formal economy. Whereas in fact in the emerging markets, it will actually formalize. And I'm using formal here very cautiously because I don't think we have the right language yet to describe what this new formality is. We tend to think about formal as regulated, but the introduction of identity, whether national or just through biometric and data, creates a more formal client that can interact and exchange with others. And I think there's a new language around this economy that we still have to create. The other part that I'm interested in, I check myself on, is that we talk about technology as if it's inserted into a static market, and not that it fundamentally shapes the underlying structure of the market, like informal, like working patterns. So I think that's something to caution against as well. It says it's not just adding technology to an old pension paradigm, but it is rethinking pensions within a new emerging structure of the economy. On the reality check side, when we talk about the next billion, I have to make some assumptions because the book is highly secret, the one that was revealed today, so I've not seen what it's actually discussed. But if we talk about the next billion, I'm assuming that means the bottom billion. I may be wrong, or a very low income billion, and that's one of the discussions that's perhaps worth having. But if we look at those markets where those people fall in sub-Saharan Africa, I mean, the one insurance regulator have one single computer in the whole regulator. In SADC, there are several countries without a single actuary in the country, or many regulators without an actuary employed. If you look at Asia, there are large government banks serving in excess of 2.5 million clients, everything based on paper. So that's just a bit of the context within which we talk about technology change, and then on top of that, pension funds, which is 2 or 3 steps down the line in terms of serving payments problems and other problems. So it is a fairly complex problem, and I think it's always risky to not bet on technology changing things very rapidly, but I do think technology is not going to reach the pockets of people that we are looking at within those countries as quickly as we may want, and it will take some careful management, like the people around this table, to expedite that. If I can segue into the pensions discussion, it's good to start with a confession. I'm also not a pensions expert, as several people have said. But in my understanding of pensions and long-term savings, there are 3 particular characteristics, and I would like to think about those and how technology can or may not solve those as we go forward. And the first is perhaps not something to solve, but to recognize, and that's disposable income and the structure of that income curve within the country, and whether it's regular and whether it can be accessed by easy deductions from a payroll. And I think the most important takeaway there is that that's not the case in the countries that we are talking about, the markets we're talking about here. And we need to, and it's not homogenous. It's not one group of people that are not employed by the formal sector. They are very different structured employment, very different locations. And we need to think carefully to whom best the micropension solution applies and to whom Social Security needs to apply or other risk management mechanism as a means for safeguarding welfare accumulation. The other aspect that I've always understood is that tax plays a major role, tax deductions and the incentive that it provides for people to accumulate. So in this space, we're not going to have that luxury of people being taxed to incentivize them to do that. And we need to think carefully about how we are going to incentivize people, because the third point is whether it's de jure or de facto, pensions are often compulsory, whether by your employer. I mean, you can opt out sometimes, but there's a large segment of compulsion involved. And what we're talking about here is voluntary. Now, I can tell you, we can talk perhaps about the microinsurance experience around technology, which is relevant here. But voluntary contributions is the holy grail of microinsurance, and it doesn't exist yet. The technology solutions that we have in the insurance space have only allowed us new form of compulsion. There's very little voluntary contributions to risk products, which are arguably somewhat more tangible and real to the consumers that we're talking about, rather than longer-term pensions that are locked in. So the other dimension that I just wanted to bring in is the consumer perspective. So this is a bit of the country context and the consumer perspective, particularly because we think about voluntary contributions. And within one of our programs, the Insights to Impact Facility, we are trying to look at the better use of data within public and private sector institutions to get consumer-centric outcomes, better decisions in favor of consumers. And as part of that, we've spent a lot of time anguishing about consumer needs and trying to figure out how does the needs of consumers stack up with the products and the instruments that we can provide them. And the needs are around resilience, so how do you cope with risks? Liquidity, how do you deal with day-to-day transactions? Saving or preparing for certain goals, which is the one we're talking about here. And I just wanted to share perhaps one or two of the points coming out of that based on work that we've done in sub-Saharan Africa and in Asia, probably in about 20 countries. That the finding is that across the adult population, and this is not just the lowest income, this is the national population, very few adults prioritize meeting goals compared to the other financial needs like transfer value, resilience, and liquidity. Even when these goals, even those who do prioritize meeting goals, they tend to be shorter term, saving for school fees, saving for an end-of-year event. That's the position where many of these consumers are coming from. And that when we talk about pensions as a longer-term contractual savings instrument, we may have to think carefully to which segment of the income spectrum we would like that to apply. Maybe finally, I mean, if we think about some of the potential takeouts, I think much of the talk of technology is about the viability of technology. And there was a good presentation yesterday again about the future of work and how many jobs are going to be reduced as a result of technology. And there was an important point made that it's not just showing that it's viable for a computer to do the job of a human being. It is also, there are other factors that will determine whether it actually is adopted. And I think the same thing applies here. We could show that microinsurance is viable. We could show that technology can open up consumer segments. But from both a system and individual perspective, there are disincentives that will mean that those solutions would not be applied in the near future within those markets. So for example, the relative low returns that you may get from a pensions product will mean that a provider will not prioritize applying the new technology which is viable in that market segment, particularly if there's scarce human resources and capital, which is always the case here. And therefore, you are competing with other alternatives. And the same at the individual level, we have become very aware that we are competing as financial service providers with other alternatives, informal financial and non-financial means. And I think that is also the reality that we've seen in many of the countries we look at, that people save in the education of their children, in housing, in other forms of assets that are arguably perhaps riskier, but even if you consider risk, produce a higher return perhaps than some of the formal financial products can, at least the ones that we've seen so far. And I think maybe the last 2 points is that this point around the informal, at the lack of a better word, because I think we should stop talking about the formal, informal and formal, that we need to find different language for it. Technology is also going to strengthen that. I was interested to hear in Rwanda that there is thinking around the savings groups and things like that. The emergence of digital identity and data and the communications technology is also going to allow these informal alternatives to be more sticky and actually function better and become a stronger alternative perhaps to some of the formal mechanisms. And maybe a final word is that if I take a leaf out of the insurance development discussion of the last decade, technology was seen as the holy grail, as the silver bullet that's going to solve it. And it stopped us from looking at the larger solution set because we thought that there's a singular solution in mobile phone that's going to access people, you're going to talk to them, they're going to take up the product. And I think we've confronted the fact that those technologies don't take us all the way. So in the insurance space, it still takes us into the compulsory space. It takes us into a space that largely serves the interest of the telecoms operator to ensure loyalty rather than the insurance interest of the client they're trying to insure. And one that they place very low on their priority list, so at any moment they can pull the plug and the insurer loses 3 million policies, which they can only access through those mobile connections. So these technologies are also often owned and driven by other agendas, other business models that is often not under the control of either the regulator or the firms that we want to have offering these services.
Great. A lot of food for thought there. I want to raise something with the panel that you brought up, the kind of this demand side and how much can one expect this to be voluntary versus compulsory, and then what's the role of public sector in that? So, if we've got millions of people, even people in rural areas on low income with a phone, and there's now an app they can download, a service they can subscribe to, what are the concerns that you have? Is it that they won't subscribe? Is it that they're going to be marketed something that is really in the interest of the provider, not in the interest of the consumer? Where's the pain point here? I don't know, Mendo or Ernesto, or one of you, would you like to go ahead?
I just want to clarify Chamberlain's point. I think the way we look at that, because it's something I must answer here, we look at technology still as an enterprise solution. The world has shifted from enterprise technology to breaking. If you talk about micropension, there's something called microtechnology. Because if you take a solution for a pension system, people don't think of building a pension system anymore. They're breaking it to 100 parts and picking a piece of that puzzle and making it efficient. And so that efficient process becomes applicable to many things. And that can significantly bring down the cost of the whole systems. And that's the architecture which is world is shifting to, which is not bit of a Western narrative, more of the Eastern narrative, because what we are seeing in Asia is a complete disaggregation of the platform to small disaggregated solutions. I think that's a change which I think all of us have to start understanding better, so that this sense that technology will have this own limitation is bit of I'm not sure is a right frame of reference. That's my take on that little, because I understand where Chamberlain was heading to on that whole technology enterprise challenge.
But if you're mentioning, if I could, disaggregated solutions, from the consumer's perspective, is this going to be then that much more complicated? I mean, clearly somebody who's not with one employer is going to have more to deal with. But
so I think that's what the whole solutioning is now. They don't look at consumers. They don't look at solutions as softwares anymore. Mm-hmm. They look at platform. And within the platform, they have a whole range of financial services, whether it's it's savings, or it's a wealth management, or it's insurance, or it is a pension structure. They will come as a platform solution. They'll not be sold as a software. They'll not be sold as a single product. So from a consumer's perspective, it will be the whole life cycle solutioning happening, or managing your risk, growing your wealth, and the whole financial need you have. And that, I think the platform itself will super scale and bring down the whole structure and make it more efficient, more simple for consumer to deal with. But again, it underpins the whole need for, I think all our fellow panelists talk about, is data, identity, and the whole cybersecurity around it, because it can completely disturb the whole ecosystem if you don't think about those three things properly.
I think that, so I think definitely there's a platform to be had, and I think it really begins on a national ID, and it builds up from there. And I think the pensions platform, I think from investment instruments that need to be in place in order to make sure that the funds are managed adequately and is sustainable in the long term, has to be there. I think what you were talking about in terms of how do you drive customers into a changing the paradigm from a mandatory system, which has its flaws. We've seen the different flaws in contribution densities in formal sector pension systems, where contribution densities just break down after, even after 5-7 year period, people don't continue to contribute on a 100% basis. So we definitely need to change the paradigm and understand how to use this pension platform, starting from the national ID, starting from information and integration of the different components that you so well described, and build on top of that the different possible solutions in order to accurately probably target the different sets of population. And I think, like it was being mentioned, I think that targeting, it's a very heterogeneous group of population. So there's no one single bullet, in not only from a, probably not from a product standpoint, but maybe from an infrastructure standpoint, you can probably build on the same infrastructure that you already have in order to be able to provide that. As to the tools, there's only 2 days ago, there's a new Nobel Prize, I think you were mentioning over coffee, about behavioral economics. That's the new trend. And I think that we need to look at ways into engaging people differently. And technology has a way to be able to access and to facilitate the process. And I think the key, and I have to say, because Will mentioned it and a couple of other colleagues, I am a recovering regulator. So I think that the key is to look at it from what is the role of the government in terms of facilitating technology, into making sure that it is safe and it is secure, and to provide a marketplace and provide the access points so that the pension fund administrators or whoever provides products, different sets of products, to provide adequate services to the different target populations, because there's not going to be one single point. Eric was mentioning earlier about insurance products, and then insurance products are probably going to work. And I think we mentioned, for example, probably agricultural insurance product is not going to work for a taxi driver but probably an insurance product for his cab, for his taxi or a motorcycle might work for him. So we have to look at it from a heterogeneous standpoint, understand what it is. But again, and I totally agree, there has to be a platform. There has to be something you go off and build off that. And I do believe definitely we need to, there's been a lot of focus on making sure that the pension, that has to be almost like a given. There has to be a pension infrastructure in place. And a national ID is definitely there. And in order to be able to have access to information so that people understand who is who in this place, in this informal sector, in this informal sector space, we need to understand who's who. And perhaps it will be able to target different sets of population differently. And even to the limit where even government agencies can also target the benefits or subsidies in a different way. But that is definitely, like you were mentioning, is definitely data-driven. But there has to be a product side on the demand side, along with a very strong component with financial literacy. And I think it has to be built up over time. And I think there's no one shot, let's all save for retirement right now. Probably people are not going to, they're not going to react to that. But there's probably a way to get them involved in a slowly and introduce these type of products in a different way.
So, and I want to turn to our regulators and policymakers now, but, I think if, thinking about kind of how financial services might look, an example that somebody gave me not too long ago was like auto insurance, that when, a credit to buy a car, that nobody really wants an auto loan, right? You want the car, and that in the future, when you go to buy the car, the loan will just almost be hidden in a way. I mean, it'll be, potentially automated, and you would get the best price, you would get the, depending on your income, depending on the preferences maybe that you provided, it would just, you would have an